Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. Wednesday the 30th. I'm Guy Adami, although you don't see...
There he is. That's
Dan Nathan. Now, typically on Wednesdays, Dan, I say if it's Wednesday, it's...
Butters.
And it is Butters today, but we have a special guest. You've seen her many times on CNBC. You know that we are a huge fan of her work. Of course, that's Katie Stockton joining us today. That is very exciting for us, Dan.
Yeah, Katie, you are the founder of Fairlead Strategies. Welcome back to our program. Actually, welcome to our program.
I know. My first time. I appreciate it. It's good to be with you guys.
Yeah,
it's
and so
maiden voyage.
Maiden voyage. We got a lot of stuff to do today, but Guy, I was just telling her, you know, my good friend who often pods with me, Katie Stanton, and you know, you're always correcting me when I'm talking about Katie Stanton. I say Katie Stockton, and then when I talk about Katie Stockton, I say Stanton. They're both fabulously talented women, but we have one of them here today. So thanks. Hey, just for the viewers and the listeners' sake here, give us a 411. We know your background, but you started Fairlead, I want to say, probably what, 10 years ago? Is that correct?
It feels like 10 years. It was 2018. And I had previously been on Wall Street as a publishing sell-side technical strategist. So always focused on technical analysis in really the 25 plus years now of my career. So at Fairlead, we are an independent research provider and an ETF manager. And we're publishing, I'd say, almost 9 reports per week, and we're covering all asset classes from a technical perspective. Our clients range from retail, the smallest individual investor, all the way to the biggest institutional investor. So we are pretty broad in our scope in terms of what we're covering and who we're reaching. And our ETF is something that came as almost a byproduct of our research and also the client demand that we had. So that was launched in 2022. It's called the Fairlead Tactical Sector ETF, or TAC, T-A-C-K. And yeah, we're just plugging away here.
Well, you're more than plugging away. You're doing amazing work. We'll put that slide up in a minute. And I do have a decent memory at my advanced age. And I'll say this as well. You know, I tend to be a tad emotional at times, but one of the great things about your work is you clearly take the emotion out of it and you look at things through the lens of technical analysis, and you're very forward and I don't know, I would say, you know, again, non-dogmatic, which I think is really important, especially when you look at technical analysis. But let's start here, because it was late June of last year where you came on Fast Money and you talked about your work suggesting that volatility was become a thing. And you were spot on, because obviously in August of last year, we saw what happened. And then vol became a thing for the next 8-9 months, which is exactly what you said was going to happen. You said typically when you see this type of pattern, this will last longer than people think. So here we are basically a year later. The VIX is effectively round tripped, I want to say. Let's start with volatility. Do you see anything in your work that mirrors what you saw last year?
You know, it does seem to move in cycles, doesn't it? The volatility index, or VIX. And we have certainly moved into a low volatility regime, is what we would call it, with the recent breakdown by the VIX below support, which was roughly 17. So I would say, listen, I mean, it feels to me almost like we're too complacent here based on the level of the VIX and then also other sentiment metrics like the fear and greed index. But it's had no impact on momentum. And so we always will give more weight to those momentum gauges, the trend following indicators, even something as simple as a 20-day moving average. These are ways to smooth out the trend, eliminate some of the noise. And not until that overly sort of bullish sentiment reading that you're taking away from the VIX or from the fear and greed index takes its toll on these momentum gauges, will we really react to it in earnest? So it's pretty wild, honestly, to see how far we've come in metrics like the VIX, and yet how far the market has gone with all that in mind. But we're just trying to respect the price action. So the volatility cycle that affected much of the early part of this year seems to have culminated. It's not to say we won't see something like that resurface, but as it stands, we don't have any big signals to suggest that.
All right, Katie, help us make some sense of this. And we've been talking about this on Fast Money in our pods for the last kind of week and a half or so. When we think about earnings season, just really, simply, when a lot of these companies that are reporting right now had given Q2 guidance, we were literally in the throes of that volatility that we were just talking about, right? It had abated a good deal, but a lot of institutional investors really thought there was going to be a retest given the fact that we kicked the can down the road, but we thought that, the uncertainty around tariffs was going to cause business uncertainty, spending, consumer uncertainty. All right. So here we are now. The expectations for Q2 were low. We've had a high beat rate, and we're going to talk about John Butters, the earnings inside analyst over there at FactSet, and some of the work that he has done tracking earnings season here. But anecdotally, and Guy, help me out here. This was just yesterday. Okay. We had Royal Caribbean, we had UPS, we had I'm missing one that was down 10%. Also, we had PayPal, we had Boeing reverse, we had last week Intel, IBM, GM. I mean, the list goes on, right? Of a bunch of these names that not only didn't have bad results, they seemed fine, but yet investors sold. And then in the instances last week, and I'm sure you track this, like Capital One. They reported stock gapped up 6%, spent the next 2 or 3 trading days filling in the entire gap. Google did that. ServiceNow did that. So I can't even think of too many names that have reported, beaten, raised, and have rallied meaningfully or above those sorts of levels. So how is the indices? How are the major indices at all-time highs, but under the surface, you've had this downward volatility in a reaction to fundamental news?
NVIDIA. So I think it really is such a concentrated leadership that we're receiving from NVIDIA, the semiconductor stocks. So, they've been strong enough to keep an underlying bid to the major indices, the S&P 500, the NASDAQ 100. We have seen consolidation ensue in small cap proxies like the Russell 2000 since that earnings, since earnings started to hit the tape. So I do think there's been some digestion, and it could be part and parcel with the earnings reports that you're highlighting there. It does also warrant, I'd say, waiting for confirmation on any breakouts that you do see around earnings season. So I think it was Cadence that gapped up and cleared some major resistance yesterday. We wouldn't want to necessarily buy on that gap up, but rather make sure the stock holds above that former resistance area. And that to us would confirm the breakout. We like to see it stay there for at least a week or two in order to confirm that breakout. So that's just a general rule of thumb with any of these earnings driven moves that we're seeing. So it's just remarkable. I agree. There feels almost like there's been a structural change because, and I'll show you my chart if I can pull it up here. As we've seen the market forge higher since the end of May, we've actually had these negative divergences in the MACD indicator. So this is a gauge of, bear with me here. It's a gauge of short-term momentum. So even as the S&P 500 has forged higher, hopefully you can see this. So this is the daily SPX chart. As it's forged higher, look at this MACD. This is not great, right? So we've had a pretty weak daily MACD indication since the uptrend resumed or broke out towards the end of May, early June. And that's remarkable. That's why it feels to us something has kind of changed perhaps in the market structure. There's no way to know exactly what that is. Of course, NVIDIA is an influence. We've had that concentrated leadership still. And yet we are now adhering to things like this 20-day moving average. So if you see the blue line, it's just pointing higher. What a great way and simple way for all of us to eliminate the noise that we've seen in the market. And so the 20-day, had you kept that on your side, you wouldn't have gotten caught up in any of these pullbacks, which at times, to me, even, back in here with this MACD looking so bad, look like they were probably the start of that retest. So, it just kind of brings us back to standard technical analysis 101, I guess, and says keep these moving averages on our side, even if we don't really understand what the market dynamic is that's driving the move.
Yeah, and that's why I started with the non-dogmatic. I get caught up in all the things that, maybe I shouldn't be as focused on. And then you look at something like this and say, let this be your guide until something changes. Now, here's my question to you. And I know one day does not a trend make, but for example, yesterday, the S&P 500 makes an all-time high, 6409, I believe, closed lower on the day. Today, it's basically flatlining, understanding that, a lot can still happen. Is yesterday a day that you'll sort of put a stake in the ground and say, okay, I want to be very focused on that reversal and then see where it leads? And then my question is, at what point does it mean something?
Yeah, so it's a great question. And I already had this conversation once today with a client, in fact, where we did see these outside down days. I don't know if you can see it on the screen, but it's where you have an engulfing sort of high-low range, right, versus the previous day and then a weak close. And usually we would say that that gives way to consolidation for at least a few days or a pullback for a couple of weeks, perhaps. Notice also on this chart here, there's a red arrow lower and a 13. These are the DeMark indicators. So those are two indications from the DeMark indicators that perhaps we will see 2 weeks of consolidation or a pullback. So there are certainly indications of that. And then we look for that confirmation. So the confirmation we require not only for breakouts and breakdowns, but for these counter trend signals like you see here. And that for us would come in part from our stochastic oscillator, not to get too nerdy on it, but this is the stochastic. And when it falls decisively below 80, which it really hasn't done for some time, that to us confirms these sell signals or counter trend indications that are pretty short term in nature. So we like to always see like more weight of the evidence is what I would say in terms of, sell signals in addition to breakouts and breakdowns. And while we do have some indications of consolidation on the back of yesterday's trading, we don't really have that confirmation to make them high conviction.
Yeah, it's interesting. And, Guy talked about not being dogmatic. I have, Guy and I suffer from similar afflictions sometimes, which I don't know if that makes us great podcasting partners all the time, but we enjoy each other's company. Hopefully you guys enjoy it too. But, when I think about the S&P 500, the way it's ground higher, I know that the VIX at 16, it looks a little different on the curve, right? So it's suggesting the here and now might feel a little bit complacent, but there's always a bit more fear looking out, right? And so here is a day where we have the Fed meeting, we have data this week, between PCE and the jobs report, and then obviously the earnings. And, one of the big drivers, and we haven't really been talking a lot about this, is Treasury yields. And, the dollar has moved up, considerably over the last couple trading days. We've seen yields in the 10-year come in a little bit, 15 basis points or something like that. How are you thinking about the 10-year yield right now? And obviously there's data, like we said, in the Fed and the commentary that they have. Is it the way your work is kind of shaping up on the yield? What is it telling you right here? And I know it's a hard one because, again, things could change very quickly over the next, 72 hours.
Yeah, it definitely could. And I think we need to have the long-term context. I'm going to pull up my chart here for yields because it's so neutral, right? So as much as we're trying to get a directional bias every other day, it's going the opposite way. And the end result has been just this kind of neutral takeaway. So I think that's where we want to respect this sort of choppy price action. And you'll see, and this is our weekly report that we just published this morning, the range is pretty well defined. This is 10-year Treasury yields. I'll try to make this bigger for you. And you can see that the range is pretty well defined. We have resistance around 4.6. There's support initially actually right around 4.2. There's a support level, just a minor level. And below that, we're talking about 4%. So I'd say between that, at least the 4.2 and 4.6 area, the bias is appropriately neutral for yields. They've been tethered, I'd say, to their 200-day moving average for the 10 years. So that puts it in, again, sort of this neutral, choppy action. The 200 days slightly higher, pointing slightly higher to suggest that the momentum on a long-term basis is shifting to the upside. So that's something that I guess nags at us a little bit, but it not until we see a breakout from that range would we feel that that's being made decisive.
Katie, part and parcel to yields and to the dollar is what's been going on in the gold market. And obviously gold's taken a bit of a pause here, probably correctly so, but I don't for me at least, I don't think that means the trade is necessarily over. And I know you have a chart. So what does your work suggest about the gold market?
So we are watching gold also, that's been range bound within the context of its long-term uptrend. And we have, you can see it on the chart here, a support level that we're watching, and it ranges down to about 3,300 per ounce in August. So that's the level that's key to us for gold to hold in terms of preserving its long-term uptrend. The momentum is obviously neutral to lower short term right now, but it's still within the context of very positive long-term momentum. And we want to stay with long positions as long as that support is intact. We do feel like gold, because it's had such a good run, is maybe a little less attractive than some other commodities. So especially platinum has this major breakout. I think we've talked about that in the past. Silver even looks a little bit more, user-friendly in terms of being less steep and now having better long-term momentum in a way. So I do think there's more to do now, like the breadth is better in the commodity sort of landscape, that we don't just have to go to gold, which felt like it for a while there. It was the only thing that was trending higher consistently. Now we have some other things to take advantage of.
All right. Do you have a Bitcoin chart in there really quickly? Because that's another one where it's, like you look at this base in gold and it's like a multi-month base. If you look at Bitcoin, it broke out of a base and it's consolidating. And I don't know if you call this, then maybe it's just Guy and me who are just kind of hacks as it comes to technical analysis. It looks like a little bit of a flag pattern, and the fact that kind of has consolidated and made a new, at least establishes for now, a new range above that prior base. How are you thinking about Bitcoin?
We are bullish, and bullish in part because of the long-term uptrend, bullish in part because of the recent breakout, which we, of course, also saw from the equity indices. And yet we do have some minor signs of exhaustion. You'll see in this chart that it has a propensity to stair step higher. And so you really want to be there for the breakouts, ahead of the breakouts, and rather than chasing them, because you see a pretty quick up move oftentimes and then just prolonged consolidation. We wouldn't be terribly surprised to see some consolidation from Bitcoin, but the takeaway is positive from that breakout. It allows for a measured move projection that you can see on the chart of about 134, 135,000. And it's not, I'd say, an unreasonable objective from an intermediate term perspective. So we're constructive on it. We also like the diversification that Bitcoin and the altcoins provide. When we look at the relative strength work for these altcoins, it's actually pretty interesting and would make a bull case, because we're having, I don't know this, let me see if I can make this much bigger. We're seeing, and this is really across the board, all of these altcoins are pointing up and to the right versus Bitcoin in this relative rotation graph. And it shows momentum effectively improving for them in their ratios against Bitcoin. And when that happens, we're more likely in a risk-on type of environment. And the trajectory of this graph that you're seeing tends to maintain this kind of clockwise rotation. So it would suggest that we'll see more of the same, meaning more over the next, say, 6 to 12 weeks, rotation into these altcoins. And that to us would be bullish for the broader space.
Before we let you go, Katie, and thank you for your time, Microsoft topped out last July, early July, I think it was around 465 or so, and then spent the next 6-9 months trading sideways, cascading lower like everything else in April. But the move since April has been nothing short of historic. I think it went basically from about, 350 or so to north of $500. And as you know, not a small company, at one point probably close to $4 trillion market cap. I bring that up in the context of earnings, where we are technically, the move that we have seen, basically has not stopped since that April low. What are your thoughts on, what does your work suggest? Because I know it's more what your work suggests about Microsoft.
Yeah, definitely. And we do care about earnings reports, of course. And we're more interested, though, in the reaction from the stock, just like Dan was citing for the others. than the earnings themselves from a technical perspective. But you can see here in the monthly chart a very strong uptrend and whipsaws higher in these monthly gauges. And so that sets a tone that is bullish for Microsoft. Of course, new all-time highs are rarely bearish. But as you mentioned, we've seen just such a steep run up. This is on the daily chart. You can see how it's been nearly uninterrupted, which is pretty remarkable. So my sense is that whenever you see a stock coming in this hot to earnings, there's more of a proof point in store on the part of investors. So I'd say, if anything, it's more prone to a pullback than not. We do have some signs of upside exhaustion. I'll show you on this weekly chart here of Microsoft. If you can kind of hone in where there's a 13 there and there's one last back there, those again are those DeMark signals. So this week, as we come into the earnings report, there is an enhancement of the overbought condition to suggest that Microsoft is probably a little overdone coming into the report and ultimately might pull back or consolidate for a few weeks before that long-term upside momentum takes hold again.
Yeah, no, what's interesting, 4% implied move in either direction reports tonight after the close. On that last report, if you just want to stretch that out a little bit, Katie, for a second here, we had that huge gap. I think it was like 8%, on its earnings report. You can see it right there. It's obviously just a line chart, but that's not something you see too often in a stock like this. And the way in which it just continued to grind higher. I mean, I don't think there's been more than like a down, 1.5% day since then, if you think about it, over the last 3 months or so. And I was just looking at the options market. So let's just say hypothetically you were looking to like make a long premium directional bet. The at the money put that expires on Friday is basically $9.25 versus a $512 stock or something like that. So that's less than 2%. And again, if you're looking to hedge a position, that's not a great way to do. I just to use a term from your ETF. I mean, if you want to be tactical every once in a while and do that, especially after the stock has been up, I think 30% since that last print, 50% from the lows in April, that might make some sense. But I would generally not use a weekly. I just think that's a binary sort of trade, but if I look out to like August 15th, the 512.5 is 11.25. So you're basically getting 2.5 more weeks for $2 more. And you can say it on a percentage basis, that's a lot, but that's the way I would think about it, just from an options perspective. And then the other way is like, let's just say you think there's going to be another gap and you think they're going to be a beat and raise and it's going to turn into the next, it's going to overtake NVIDIA in market cap. Well, the flip side of that is it costs you $9.25 to define your risk into the week and play for upside. I'm in your camp as far as what the technicals show, but we'll see. All right. Katie Stockton, not Katie Stanton, Katie Stockton, founder of Fairlead Strategies. We really appreciate you being here. If you guys want to find these work, we have a QR code. Guy has no idea what a QR code is.
I do. You point your camera at it and something happens.
Wait, you really know that? Look at that. So go to Fairlead. There is obviously the Fairlead Tactical Sector ETF, but you can also get her work in your email box, fairleadstrategies.com. Katie, we really hope you come back. Thank you so much.
Of course, would love to. Take care, guys.
All right.
It's great. And, I mentioned this and I do remember things. It was like late June, early July of last year where I think actually Tyler Matheson was hosting the show and we talked about volatility and her work suggested you were about to see something happen and she was spot on and it lasted for the duration that she thought. So it's great. It's an honor for us to have her on and it's great to sort of have a new voice. New looking charts just to give people sort of a different feel about things because everybody does technical analysis a little bit differently and she does it really well.
Yes, sir. All right, Guy, we got a lot of data here today. We got earnings reports tonight after the close. We have a Fed meeting. We're going to get the 411 on what is going on within the FOMC. We have Fed Chair Powell. This is going to be exciting, actually. His presser. I know that generally.
Oh, yeah, that's must watch.
I know that you are generally on the edge of your seat. 10 times a year, Fed Chair Powell comes out. He's going to kind of talk about the inner workings of monetary policy and the like, and what they see, and maybe some dots and this and that or whatever. So that's this afternoon. And then we obviously have more earnings. We have the all important jobs report. We have the Fed's most favored reading for inflation. What is that again, Guy?
That's PC.
All right, let's quickly start with GDP this morning because, a lot of folks were kind of caught off guard. Q1 GDP. It was negative. That was the last time we heard much about the recession, or the R word, if you will. You get a rebound in Q2, 3%. I think a lot of economists are expecting just below 2% annualized here for 2025, which I think for all intents and purposes seems okay. It's why a lot of folks think with inflation going back towards the Fed's 2% target, right? If you have 2% growth, you got a 2% inflation, and you have a Fed funds at 4.5%, a lot of folks think that something's got to give here, Guy.
That's a green light. If those are the numbers, green light for the Federal Reserve to go back to, or continue, whatever word you want to use, reinstate the rate cutting cycle. Okay, that's fine. I get it. So a couple things, and going back to Peter Bookvar, who you mentioned, Peter's work, and he said this weeks ago, suggested they're going to get some really noisy numbers over the next couple months. And I think the headline number is great, right? But what's the noise embedded in the number? And as you've said, does that incorporate all this pull forward ahead of tariffs and those types of things? And again, I'm not an economist, so I don't know, but it obviously surprised the upside in the same way the previous report surprised to the downside. So to Peter's point, you got a lot of noise here. Now, through the lens of the market doesn't seem to be all that impressed one way or the other. Not a lot is happening with an S&P unchanged. Bond market under a little bit of pressure, having rallied over the last couple of days. So not a lot to see there as well. But you start to parse through this thing, and again, to me, it doesn't scream, okay, Fed rate cuts are on the table, or Fed rate cuts should be coming. As much as the administration and people around the administration are going to call for it, as much as people are going to continue to tweet, today's a good day to fire Jerome Powell. In my opinion, none of that makes a lot of sense.
Yeah, and part of it is, we have this trade deadline. This is on Friday, and the president has come out this morning. It sounds like they did not make a lot of progress with China, and that's been the third round of talks, I think it was, over the last two days in Stockholm. And, we know how this president operates, right? He speaks loudly, but he carries a small stick. You see what I did there, Guy? Kind of reversed the old Teddy Roosevelt thing from, you remember when you heard him say that speech. Were you
we were sitting by the radio that day when he said it, and I didn't really fully comprehend because I was young.
You just didn't think that was going to be something you'd hear in your political science classes, 6 years later.
No.
Sort of thing. Okay. But, it'll be interesting to see when we get to that August 1st deadline. I do think it's also interesting that he's kind of tightened his tone a little bit with Russia about a ceasefire with Ukraine. And now he's throwing 25% tariff on India, threatening them to stop buying Russian oil. They're threatening economic sanctions. I think all of that does complicate things a little bit if you think about the mashup between geopolitics and trade and where the Fed sits on this, right? So if the Fed now thinks about, okay, maybe we do start to have that green light a little bit. Maybe the president is saying the economy is strong enough that we can lower interest rates, that lowering interest rates is not going to restoke inflation, right? And so maybe that is one side of the coin. The other side of the coin is that growth starts to disappoint to the downside because of the impact of tariffs that are going to be higher than what they were 6 months ago or a year ago, that sort of thing. So the wait and see approach by Fed Chair Powell makes some sense. We've talked a lot about how he thinks about the independence of the Fed and his legacy. He knows in less than a year he's out. He probably knows in the next few months that there's going to be a shadow Fed chair and a campaign in and around that announcement that is going to continue to put pressure on that meant to be independent body, right? So he has an opportunity right now, stick to his guns. He probably realizes coming into 2026, he's going to be like, what do you call it? A lame duck for all intents.
Lame duck.
Yeah, lame duck. So, I just think if we look at the CME Fed funds tracker, there's no movement. Nothing's happening today here, right? If you look at September and then you look at, like in the back half of the, it looks like we're going to get a 25 basis point, at least at one of those meetings, right? Towards the end of the year. So I guess I have one question for you, Guy, is that let's just say one of these folks that have been interviewing for this Fed chair position, right? Let's just say they get announced in the next few months. Let's just say they go on a speaking tour, right? And they're just kind of laying into it. And let's just say there's a lot of lawmakers, and you see that there's going to be a little bit of pressure on that independent Fed with the next chair, right? What happens when that Fed chair comes in May of 2026? Do they literally just do a 50 basis point cut and just say, we're going to do the White House's bidding? Because that would be the sign that all things have changed with an independent Federal Reserve.
That logic suggests that the next person is going to do exactly that. Okay, so let's just play it from there. Now, what I asked Steve Leisman the other day on Fast Money, and I believe this to be true. History suggests every new Fed chair is challenged by the bond market, and I don't think it's going to be any different with whoever the next person is. And I think the bond market will challenge him. In terms of the rhetoric around it leading up to with May of next year, I think is when he's out in terms of his term. The rhetoric's going to continue. But if you just said it, if the economy is strong as this 3% GDP print suggests, the counter to that is there's no reason to do anything. I mean, the economy seems to be going along just fine. Job market, at least the headline numbers, seem to be just fine. I mean, there are clear things under the surface that are concerning, but not bubbling over in a way that I think necessitate a rate cut. And, I think a rate cut at this point, whether it's now or September, I think it will, all I think it's going to do is it's going to embolden the bond vigilantes, a term that I'm reticent to use, just to be more vigilant in terms of what they're doing. And I do think you're going to see this continued upward pressure in yields. I mean, in the last couple of days notwithstanding, I'm one of the few people I think out there that still think yields are going higher. And I don't think they're going higher for the right reason. So all those things, you throw them all into the kettle and you see this sort of pattern we have. I mean, you can say you have this pennant formation. I mean, that's a static chart, but you can draw a downtrend line from the high yields in earlier this year or late last year. You can draw an uptrend from the April lows. You're going to see that pennant, and it's just a question of which way does this thing break? And I think it breaks to the upside. Again, I'm not suggesting I'm right. That's just my view. And here it is just for the visual portion of our home game.
Yeah. And, Peter Bookvar, Bleakley Advisors, actually it's called 1 Point BFG now. They renamed Guy. Peter was on the pod with me yesterday, and we were talking about, a big component of this is also, and some of the data we've been focused on is the housing market and what that has meant, right, for a U.S. consumer that, for all intents and purposes, it's not moving. We're not getting the sort of movement that a lot of folks would like in a healthy economy, if we do have a healthy economy. But a lot of folks are kind of have these great mortgages, right? And they're not going to move. And then you have this other, situation where labor for new housing starts, you have, which is obviously going to be something that's challenged with deportation. You have input costs. I mean, you can talk about an EU deal that's now 15% tariffs, but there are still 50% tariffs on copper, aluminum, steel. We don't have a trade deal with Mexico and Canada. Those are two very big components, right, of our trade with them. So the housing market is a bit stuck. We also have a situation where year over year, okay, we have the Fed funds rate down 100 basis points from 5.5 to 4.5 at the upper bound. The 30-year mortgage is still at 6.85. Of
course it is.
It was last year. It was 6.85. You know what I'm saying? So you've made this point on many occasions. Do whatever you want. Have a ball with the Fed funds rate. You know what I mean? The 2-year will track that, but the 10-year and a lot of stuff that's longer term that is based on, you know what I mean? Like it's not based on what the Fed is dictating for Fed funds. And that's where I think you're in good company, Guy, because our main man, Wilfred Frost, had David Solomon, CEO of Goldman Sachs, on his podcast, the Master Investor podcast, the other day, and he is in your camp, Guy. He thinks that you're going to see longer term rates move higher.
Yeah, and Jamie Dimon, listen, I'll preface this by saying Jamie Dimon's been saying a lot of things over the last couple of years, some of which have come to fruition, other things not so. And he's been, obviously, I think if you're being honest, he's probably been a little more pessimistic than most, but he's also made the point that he does think that rates are going higher for the reasons, many of the reasons that we've articulated, some different reasons as well. And he's also said that if in fact that is the case, his bank is extraordinarily well positioned to take advantage of that, which I absolutely believe. So we'll see how it plays out. Again, this belief, and I think it's it's a long-standing, pretty wide belief that somehow the Federal Reserve controls interest rates, when if you just look at it, it's pretty clear that they control part of it, but they don't control the entirety of it, and the entirety is what matters. So lowering rates here, I don't think it helps. I think it hurts more than it helps. I mean, the market might like it for a couple days until it figures out, wait a second, there are other things at work.
Yeah. And I guess like we're in the middle of earnings season. Okay. And so let's actually go. We get a preview of our main man, John Butters. He's the senior earnings insight analyst over there at FactSet.
Yeah, he is.
What do you call him, guy? You just
call him Butters. And you know what's funny about that is it's caught on. It's sort of like, I'm sure that Cher wasn't Cher the entirety of her life. I'm sure that she went by a first name and a last name, and now she's just Cher. And
you know that name? Do you?
I could probably look it up. You know, I don't know, like Charo, for example. I mean,
yeah, she's still got it going on. By the way,
Charo or Cher?
Share. All right. So it's Wednesday. We get a look at John Butters' work. He is the senior earnings analyst over there at FactSet. He writes the Earnings Insight blog. You can have it every Friday morning in your email box. Go to factset.com/insight/subscribe. All right. This has been a week, guy, not just the data that we're talking about, not just the Fed presser, but we also have 40% of the S&P 500 earnings reporting this week, right? And so Wednesday after the close, the two big ones, Microsoft and Meta, tomorrow, Apple and Amazon. And I just want to hit some things that Butters had to say in his report. The market has rewarded positive EPS surprises more than average and also punished negative EPS surprises more than average for Q2 to date. The S&P 500 companies reporting positive EPS surprises have seen an average price increase of 1.9%, which is larger than the 5-year average of 1%. S&P 500 companies reporting negative EPS surprises have seen an average price decrease of 3.3%, which is larger than the 5-year average of 2.4. All right, let's stop there for a second because we've been highlighting this. We just had this great conversation. It's in the market call feed with Katie Stockton of Fair Lead Strategies. And we were talking about, I can't think of too many positive surprises, guy, for, let's put aside what John is just reporting on, that we're up more than 5% after the print. But I can think of easily a dozen S&P 100 names over the last 2 weeks that were down more than 5%, many down 10% and more. Just yesterday, we had UPS. That stock has not seen an uptick, guy, in 2 days. It's down like 15%. We had Royal Caribbean. There's been a handful of others just over the last few trading days or so. So to me, it seems like where we are with the markets, and again, we are in rarefied air, as Peter Bookvar called it yesterday. It seems like it's a 1-up, 3-down sort of risk reward into earnings season if you are a stock that is massively outperformed and you got a lot of eyeballs on it.
And let me build on what you're saying. I think we're at the part of the cycle, the market cycle, where if you do well, you guide higher, you're going to be rewarded. If you do poorly, you're going to be basically punished. But obviously on either side, more so in terms of standard deviations than history suggests. In other words, if you do well, your rewards are going to be better than expected. And if you do poorly, much worse than expected. And to me, that suggests we're at a bit of an inflection point here. On top of that, what you just mentioned is the stocks that are being rewarded in the very short term are seemingly giving a lot of it back over the ensuing couple days, where the stocks that are being punished seemingly don't have much of a bounce. And that's something I think to watch very carefully. Now, again, an S&P 500 making an all-time high yesterday, it's hard to sort of listen to that and say, why does it matter? But we're at that point now where, things, although volatility suggests one thing, the bands around winners and losers in terms of earnings are getting wider, which suggests we're on the precipice of something, in my opinion.
Yeah, and that's a point that we made on many occasions. So when a lot of these companies in late April or early May were guiding for Q2, they were already 1 month into the quarter. Things had not changed other than the price of their stocks, right? But a lot of the outlook and the commentary in general was soft, right? So here we are now, we have this high beat rate and, companies have kind of gotten over those hurdles, I think, that were cautious, and they're not being rewarded. I mean, I think that's what we're talking about. But then if you come in and you didn't meaningfully beat that, and then the commentary that you're giving right now is still cautious because we don't have a lot of clarity on the trade front. We don't have a lot of clarity on the strength of the U.S. and the global economy. And so this is the last point that Butters makes here, Guy. The positive price reactions to earnings beats may due to more optimism on earnings outlooks for Q3. Okay, so let's like kind of pull that forward now. Analysts have increased EPS estimates slightly in aggregate for Q3 to date. EPS guidance for Q3 has been less negative than average to date. And, you know, one of the things that Butters was tracking as we entered into earnings season is how much Q2 estimates had come down over the prior few months. And that's kind of what we're talking about as far as expectations. So here we have a scenario where estimates are moving higher with the stock market at all-time highs, with valuations at highs we have not seen in 25 years. We had David Rosenberg's report yesterday talking about 60% of the gain in the S&P 500 is multiple expansion. This seems to me as a bad setup right here. You put all those things together.
Yeah, I agree with you. And, you know, you start connecting dots in terms of some of the guests that we have, whether it's on Market Call or Risk Reversal podcasts. You know, I go back to Stephanie Link probably now 3 weeks ago, maybe 4. And she talked about her belief that these earnings, you know, she thought we'd see low double digits earnings growth. And, you know, that sort of dovetails with some of John Butters' recent work that we've done. And it's really, when you start to connect the dots and listen to the different voices, you can sort of you can start to put together this puzzle a little bit better. So I look at this, I hear what Stephanie Link is saying, and it's starting to come to fruition. Then I say, okay, wait a second. What Stephanie said is right, yet the companies that are surprising to the upside in terms of the stock prices, it's not sustainable. And the companies that are missing are being punished, and you're not seeing any bounces. What does it all mean? So that's how I try to sort of navigate this whole thing. And that's why it's important to listen to all these different voices, see what's going on in the market, then listen to a Katie Stockton we had on Market Call earlier and figure out where we are in terms of the cycle. And I would say when you put all this together, we're sort of, you know, late innings of this entire game, in my opinion.
Yeah. All right. Well, thanks to John Butters, senior earnings analyst over there at FactSet. He writes the Earnings Insight blog. It drops every Friday morning. You have it in your inbox, factset.com/insight/subscribe. All right, Guy, before we get out of here, by the time a lot of folks are listening to this, the Fed will have probably already kind of come out with a rate decision. We know what's going on there. Really, I think what a lot of folks are just really, you know, kind of fixated on is whether we're going to have a slightly more dovish tone, like pointing towards, you know, a fall rate cutting cycle that kind of continues again. It would be basically 1 year to the point in which they started cutting interest rates. And at that point, it was the first time in 4 years. You got to go back to 2020, right? So there's not a meeting in August. We have the Jackson Hole confabby thingamajiggy, and then you have a September 18th meeting. So a lot of Fed stuff going on in between there. But then this week we have PCE Thursday morning. We have jobs on Friday. Tomorrow night we have two big Apple and Amazon, and then we have trade deadlines. All of this, if I'm a bull, if I am all in on the stock market, I didn't get shaken out in April, I didn't sell too soon in May or June, you know what I mean? I feel good about all the things that we laid out, about growth, about inflation, about trade war not being as bad as some people thought 3 months ago, this or whatever. I think one thing that would be healthy, which we have not had since the April lows, really, is a little bit of fear put in the market, right? Like, so if all of these stuff, and they're not all going to go in the same direction, right? All those things that we just laid out, but something that caused the VIX to go to 20, something that caused the S&P to go down 3, 4, 5% or something like that, and make people reevaluate what they hold and why they hold it, right? Like that stuff to me would be very healthy, because then it gives the opportunity for some people to get back in, right? Like that sort of thing. If you're starting to see, and we started off the week talking about Mike Wilson, friend of the show, great friend of ours for decades over there at Morgan Stanley. He's starting to think about his bull case that he had kind of laid out, I want to say 6 to 9 months ago, about an S&P 500 that in 12 months could get to 7,200. We're just below 6,400. Talk to me about the potential for a little fear being put in the market and whether you think that's bullish or bearish if it happens.
Well, fear putting back in the market would be bearish for the market almost by definition. Number one, you know, it's again going back to Katie Stockton. her work, unlike this time last year, suggests she doesn't see anything on the horizon in terms of volatility, but that doesn't mean it's not out there somewhere. So the next question is, what is the catalyst for that? And is it sort of a line in the sand in terms of this August 1st, which, by the way, is Friday, believe it or not, in terms of the deadlines and stuff? And what, if anything, is the rhetoric around it? And, what is the response around it and those types of things? So as much as it pains me to say it, I mean, that's, to me, in terms of the market, I mean, the market is still laser focused on everything around tariffs. Now, the other thing that's sort of hiding below the surface are all these indicators in terms of housing inventories that are probably at the highest levels we've seen in a decade or so, delinquency rates, which continue to sort of tick higher, valuations, which, as Dan Greenhouse pointed out last week on the podcast, are not a timing indicator. We have said that time and time again, but the higher these valuations go, the less and less cushion there is in terms of valuation cushion for the market. So you throw all those things in the pot, and a 15 VIX does not take any of that into consideration.
All right, guy, we got a hot one this week, not just outside. It's like 95 degrees here in New York. The smells that
can I ask you, I don't know if this is a doxing thing or not, so I apologize.
Dox.
Today, let's say Wednesday the 3rd. Tomorrow, aren't you doing something tomorrow after the show?
Oh, yeah. BK. What do you call him?
I call him BK.
No, you call him the ball. BK.
BK, he's a Bitcoin. He's the original Bitcoin ball. He wrote the book in 2014.
Yeah, he did. The Bitcoin Big Bang. I actually, this is a great story really quickly. So Brian Kelly, he's been doing fast money with us forever. He started a digital asset fund, I want to say like 9 years ago, BKCM, and he wrote the book, as you said, in 2013. I went to the book opening. There was like literally 15 people. I've said this before. It looked like the cantina scene in the Star Wars movie, all these Bitcoin people. This is going back 12 years ago. And he's just been one of those steadfast guys. You and I have learned so much from him over the years. He is a great friend of ours. He's going to join the pod tomorrow, which will drop on Friday. And we're also going out a boat around Manhattan. Guy, you were invited. You just don't like to go out on boats. You actually just don't like to.
You could have left the on boats part out. Yeah.
Yeah. You just don't like
to qualify.
You just don't like to go out. So
you say all the time, like, I don't enjoy fun. That's a phrase you've used.
You are a fun guy who does not.
I'm not. I'm really not.
Hold on. You are a fun guy who does not like to have fun.
That's interesting. It's probably some.
No, most people that around you, Bill, you see what I'm doing there? Most people like believe you to be a fun guy. You're a funny guy. Like, you amuse me. You know what I mean? Like, that sort of thing. But you don't like that. But we're going to have fun with BK.
Yeah. No, listen, nothing I would more enjoy than to be on a boat for 3 hours in August in New York, 90 something degrees, humidity levels through the friggin' roof. Probably some chop out there. Yeah, that sounds like a ball.
Well, it's a 3-hour tour there, guy. Would you rather? Let's do would you rather.
Okay, I like this game.
Let's go. Gilligan's Island, it's kind of like desert island sort of stuff. Where are you going? Like Ginger, or are we doing like what are you leaning towards?
So you're gonna give me, that's the would you rather?
Yeah, not Mrs. We're
Mrs.
not going,
Howell. By the way, Mrs. Howell, they called her Lovey on the show.
Lovey.
She was like, you'd think she was like in her 80s when they filmed that. I think she was like 46 or something. Yeah. So
I'm just saying, like, would you rather? The professor, he had his pick of things.
Love the professor. The professor, I think, was a fighter pilot in World War II or maybe Korea, if I'm not mistaken. That, of course, Russell Johnson. Dawn Wells played the role of Marianne. Now, in the first season of Gilligan's Island, you recall the jingle basically named all the people. There you go. It's a great picture.
Wow.
And the rest, though, and the rest, of course, being the professor and Marianne. And Bob Denver then went to the producers and said, that's not cool. This jingle is not cool. You have to name them by name. So if you go back to season 2, and Professor and Marianne replaced and the rest. Little known fact.
Oh, nice. Okay, I did not know that.
Well, you should go.
And I'm not. This is not an age joke. You were literally watching this first run. Is that 100%. Fair to say? Yeah.
100%.
So by the time I was watching it, it was definitely on syndication. But Ginger or Marianne, guy? The viewers want to know.
Well, most people, it's the answer over the years has become Marianne but then people are not, you're really not paying enough attention to Ginger. So as much as people want to say Marianne because they think it's the sort of the non-traditional route, I mean, it's hard to argue with Ginger.
I think it's hard to argue with either. And Mrs. Howell, I think she's a sleeper. Let's be clear. You know what I mean? Like, depending upon how things had kind of lined up, I think that you might have ended up okay. All right. On that note, I think that was me. I don't know how we got to a 3-hour tour.
Well, I asked you who you were going.
BK. Brian
now,
Kelly.
by the way, a lot of people don't know this. I guarantee if Doug Cass is still here or if anybody is still with us, people just remember Alan Hale as the skipper because that's all he was referred to as, the skipper, by everybody on the island.
Yeah.
He had a name, though, and his name, get ready for this, Jonas Grumby.
What? That's amazing. That sounds like a cartoon character.
Go to your Google machine.
By the way, the show was a bit of a cartoon, if you think about it. Like, they never changed their clothing for the most part. The Howells did or something like that.
No, they had Ginger had every piece of wardrobe in her apartment.
For a 3-hour tour, why would you have?
Yes, well, that's exactly right.
It makes no sense. But then all the things that they would be on the island. You know what I mean? Like, listen.
No, but let me ask. Look at that. Who is that? Who pulled that up?
Jonas Grumby.
Is that Jacob? That's tremendous. The real question, amongst many, by the way, there's a laundry list of questions one has to ask and answer. But if the Howells, Thurston Howell III, and Lovey were as wealthy as they said they were, or basically they told everybody they were, what the F were they doing on a 3-hour tour with those two dipshits?
All right. On that note,
right. Think about that. Yeah. Like, listen, we can buy and sell this entire piece of property, but we're going to go on a 3-hour tour with Gilligan and Fred and Jonas Grumby. It makes no sense.
True that.
Okay, Dan wants out. You know that I'm right, though.
I do know.
And there are about 5 people on the planet that could have pulled Jonas Grumby out of there. You know what?
All right, so tonight, wait, hold on. Tonight on Fast Money,
I'll get Jonas Grumby in.
No. Well, yes, you will. A, but B, the first thing you got to do, not on screen, you got to ask Tim Seymour if he knew.
You know what? Tim would know, but he's not on the show tonight. But Tim would know.
Save it for the show. So the next one, we got to figure that out because you guys don't get this. What goes on in the commercial breaks on Fast Money is really funny. Guy and Tim, okay, this game was absolutely amazing. So you guys, this was the other day, you guys were doing draft picks for the White Shadow, like which players you would have been picking if you were doing a pickup game, right? That happened, okay? And there was something else that was nearly as ridiculous, but it was certainly amusing. Like something.
It's all true. I mean, the White Shadow draft picks that's good stuff. Yeah, because I'm going with my man Coolidge.
All right, the other one was the Bad News Bears. You guys were going through the roster, what your lineup would have been like. You know what I mean? Like, that was Bill. You don't even know these things. You don't know of these guys. You don't know of these teams, but that was really funny too. All right, we got to get out of here. I think Jacob is going to cut most of that stuff for the audio podcast store. Thanks so much for being here.